Paramount in 2022 looked like the perfect value play. PE ratio in the low single digits, 6% dividend, price to book ratio below 1, and on top of that, Warren Buffett even owned 15% of the company. But the stock went on to drop by nearly 69% since then. Paramount is the perfect example of a value trap and demonstrates why value investing is so much harder than it seems, especially for beginner investors. Let's look at what went wrong and what we should do instead. In 2019, two household names merged together. CBS, an American multinational media company, and Viacom, a media conglomerate, once one of the largest in the United States. They owned cable television streaming services, radio, and TV stations. These two companies merged together to create Viacom CBS, and then in 2022, they renamed to Paramount to take on the world of streaming and slowly begin the transition away from legacy media. And it was in 2022 that Warren Buffett bought 15% of Paramount early in the year in 2022, around $30 per share. And it was at this time that value investors were seeing a lot of good things: a household name, solid value metrics, a fat dividend, and backed by Warren Buffett. But let's take a closer look at the cracks that were forming with these value metrics that you would miss if you were only looking at a surface level. First, let's investigate this price to book ratio being less than 1, which looks really good on the surface. So first, let's break it down. Price is the price of the company. You can calculate this by multiplying the current share price by the number of shares that there are. Or you can just look at the market capitalization. So price divided by book. The book value is the value of net assets of the company. You can calculate this by adding up all of the company's assets and subtracting all of the company's liabilities, and boom, you get the book value, also known as the shareholder equity. Let's look at an example of this of Paramount in 2022. I'm on the balance sheet in 2022. I can scroll down to the total assets. I can see $58 billion. The total liabilities is $34 billion. And therefore, the shareholders' equity is $23.6 billion. Now, at this time, the market cap was lower than $23.6 billion. And I can see that if I go to ratios. In 2022, the market cap was $11 billion. So what that means is that this company appears to be on sale because I can pay less and get more equity. Most companies, the market capitalization is much higher than the book value. And to see an example of this, let's look at Apple. Currently, Apple has a shareholders' equity of $66 billion, but the current market cap is $3.1 trillion. So this is a price to book ratio of 47. So 47 compared to a price to book ratio of less than 1, it appears that Paramount is a huge deal, but there are some major red flags here. If I go back to Paramount's balance sheet in 2022, right here, I can see that a huge percentage of their shareholder equity, which let's remind ourselves is 23.6, a huge percent is goodwill and other intangible assets, which is about $19 billion. Now, goodwill is very common. Goodwill refers to the premium purchase price paid over book value for net assets acquired. So Paramount has assets that it acquired and it paid more than the book value, which is normal. Remember, if we were going to buy Apple, we would have to pay 47 times the book value. So it's completely normal for companies to have goodwill if they've acquired assets and other intangible assets. The problem is that Paramount is in a transition period where the bulk of their assets are in legacy media, and legacy media is currently suffering to streaming. So it would not be ridiculous to think that their goodwill might go down in the future as the bulk of their assets are in legacy media. So if they were to lose, let's say, $6 billion in goodwill, sure, it's a small percentage of their total assets. But when I look at it as a percentage of their shareholders' equity, $6 billion is actually a huge percentage. And spoiler alert, that is what went on to happen. Now let's look at the next red flag, their fat dividend. Normally, when a company's share price drops so much that the dividend rises to 6%, that is a strong signal to value investors that this is going to be a good investment. However, Paramount is in a transitionary period where their legacy assets are projected to weaken as streaming is on the rise, and they have to spend a lot of cash on investing in their new streaming segment of their company. So these two things happening at the same time puts Paramount in a very tricky cash position. And we can see this unfolding on their income statement. First, I can see that their revenues have only increased by about $5 billion from 2020 to 2022. Meanwhile, their total costs and expenses have increased by $6.5 billion. So we have rising expenses outpacing their rising revenues. Next, we can look at their cash flow statement to see how is this company actually coming up with the cash to pay its dividend and pay for its new investments in streaming. I can see three major sources of cash flow in the investing and the financing activities section. So in the investing activities, I see proceeds from dispositions. This is Paramount selling a portion of their company. This is them selling their media legacy assets for $3 billion. They were forced to sell assets to come up with cash. They were forced to issue more debt. This is proceeds from issuance of debt, $4.3 billion. And then finally, they had to gain proceeds from issuing preferred and common stock right here. This is $2.5 billion in issuing stock. All three of these things are bad for shareholders. They are selling off legacy assets to raise cash. This is going to reduce their revenue that they would have gotten from those assets. They're forced to issue more debt. This is going to result in a higher interest payment, which is going to mean more cash being taken away from the dividend. And finally, they issued more stock. That means they have more dividends to pay on more shares of stock. It also dilutes the value of existing shareholders' stock. So all three of these things, not sustainable if they're going to continue to pay their huge dividend, which we can see right here, dividends paid on preferred stock, dividends paid on common stock. This is 6.8, nearly $700 million in dividends paid on top of their payments in interest, which I can see if I scroll back up to their income statement right here, interest expense, $931 million in 2022. So as a value investor in 2022, if I were to look at Paramount's dividend growth history, I would see 7 years, 8 years of historic dividend growth leading in 2022. And then spoiler alert, they had to cut their dividend in 2023 because they are having to put so much cash into revamping their business while simultaneously losing revenue from their legacy assets. Finally, let's talk about the last value metric that looked good, but it ended up being the final nail in the coffin, the low PE ratio. In Q1 of 2022, the PE ratio of Paramount was 6.12. Having a PE ratio below 10 is incredibly rare for a company. Once again, if I go back to Apple and look at their ratios, they have a current PE ratio of 33. What that means is you're paying $33 for every $1 in company earnings. So the less you have to pay for earnings, the better. In theory, it turns out that Paramount had a low PE ratio for a good reason. Scrolling back to Q1 of 2022, a PE ratio of 6.12. Once again, this is a transitionary period for a company. Paramount is simultaneously losing revenue due to its legacy assets decreasing in value while putting more money into expenses through investing in their new segment of streaming. It turns out Paramount had a low PE ratio for a good reason because the market was assuming that their earnings was going to drop in the future. If the price of a company stays the same and then the earnings drop, the PE ratio goes back up. And that is exactly what the market was projecting. And it didn't take long for all three of these value metrics to completely flip course. First, in 2023, Paramount had to cut its dividend by roughly 60% to help out with the rising cash requirements. Then in 2023, they started missing their revenue projections. This was due to streaming lagging behind and their legacy assets producing less revenue. This was amplified by the fact that they had additional costs as they're investing in their streaming segment. Then in 2024, they had to write down their assets and take a $6 billion hit to their goodwill, which resulted in a loss, which hit their PE ratio. Suddenly they had a loss. Their PE ratio flipped to the negative. It wasn't low anymore. It's now negative, meaning they're actually losing money. And then the final nail in the coffin in 2024, Warren Buffett pulled the plug and sold his entire holding in Paramount, resulting in a huge loss for him. Beginners often have such a hard time with value investing because beginner investors rely too heavily on the value metrics. And these value metrics are backward looking. They only take into account past performance. But the stock market is valuing companies by looking forward. The market is always predicting where they think the company is going to go. And that's where these value metrics fail. Paramount was priced low for a reason, because this was not a value play. This was a speculative turnaround play. And value investors were tricked into thinking that this was some deep value stock with a price to book value of less than 1. But you're only able to profit off of these deep value plays if, number one, you're Warren Buffett and you're able to buy out the whole company and then actually sell off its assets and its debt to profit off of that low price to book ratio. Or if you know intimately the industry or the sector and you can see that the market is pricing this company incorrectly, it's way too low, it's deep value, you're not going to get that without some serious expertise. So as a beginner investor, value is very difficult because you have to be forward looking. And Warren Buffett himself, he doesn't use this cigar butt method of investing anymore. Back in the day, he would find these dirt cheap companies. It didn't matter how crappy they were. As long as that old cigar had one free puff left in it, he could liquidate the company and make a profit. But now Warren Buffett is famous for saying that he doesn't buy fair companies at a great price. He wants to buy great companies at a fair price. So how does a beginner investor find a great business at a fair price? Well, the first step is to focus on growth. A company that is growing their revenue is more likely to be a great company, and they are more likely to have their share price increase in the future. One way that you can see revenue growth is by looking at past revenue growth. It's not the end all be all, but a company that has succeeded in growing their revenue over the next 5 years is more likely to continue growing their revenue than a company that has begun to shrink. And with Paramount, we can see the signs that their revenue is starting to shrink. On their annual report for the 2022 fiscal year, we can see that their largest segment, TV media, which makes up 72% of their revenues, dropped by 4% from 2021 to 2022. This is a really bad sign. Now, to get a better feel of the future revenue growth of a company, unless you have intimate knowledge of the industry or the company, I like to rely on the professional analysts. I like to go to stockanalysis.com and look at the analyst predictions for a company. Now, with Paramount, if I pull up on the Wayback Machine, Yahoo Finance on November 6th of 2022, I can scroll down to the analyst projections. And for the next 5 years, analysts were projecting 11.5% revenue decrease on average over the next 5 years. So with Paramount, the signs were there that growth was going to slow and that revenue might not continue to increase. And to make sure that a company is growing and it's priced fairly, we can look at the PEG ratio, not the PE ratio. That's price to earnings. The PEG is price to earnings to growth. A PEG ratio between 1 and 2 is generally considered fair priced, while a PEG ratio of less than 1 is considered undervalued. And then a PEG ratio of much greater than 2 is considered to be a red flag, and the company could be overvalued. The next red flag that I like to look for in a company, after I'm confident that they're going to continue to grow in the future, is cash flow. We saw with Paramount that they had cash flow difficulties, which resulted in them having to cut their dividend. They were forced to sell off segments of their company. They were forced to take on more debt, and they were forced to issue more shares. All three of those things were red flags. So for a company that I'm looking to invest in, I want to see free cash flow positive, which Paramount also went negative on free cash flow in 2023. And I want to see high margins, which Paramount had low margins even in 2022. On Paramount's income statement, I can scroll down to the bottom on stockanalysis.com, and I can see that the gross or the operating margin was under 10%, the profit margin was only 3.4%, and the free cash flow margin was actually negative in 2022. This is a major red flag. And finally, the third red flag that I look for is debt safety. We saw with Paramount that they had a very high interest payment, over $900 million, which caused them in part to have to cut their dividend. And the metric that I look for to make sure that a company has low debt is the debt to equity ratio. I want to see a debt to equity ratio of less than 1. And I like to check the interest payment and make sure that they don't have too large of an interest payment compared to their earnings. For Paramount, on their income statement, I can see that they had an interest expense of $931 million. And after I go to their pre-tax income, they only have $1 billion in pre-tax income. So as a percentage, this is a huge percentage in interest expense. This ate away at their cash and caused them to get into debt trouble, issuing more debt, issuing more shares, and selling off segments of their business. There's just no reason for beginner investors to bet on a company that has a red flag in any one of these three key categories: revenue growth, cash flow, and debt safety. There are so many companies out there that we can afford to be incredibly choosy before we make an investment in a company that we think has strong value. Before I spend any time at all doing a deep dive into a company, I check for these three red flags and others that Warren Buffett uses to evaluate companies. If you want to see some next level red flags, check out this video right here.